All right. Well, welcome everyone. My name is Donna Craddock, and I am one of the co-owners of the Doc Bookshop. And we are so excited to have a wonderful guest with us today for National Black Business Month. His name is Xavier Egan. He is a serial entrepreneur, a businessman, alpha man, all that. And so I'm going to let him introduce himself. But again, thank you all for being here. He's going to talk, and then afterwards we'll do a little Q&A, and then we'll do the book signing. And if you're in the DFW area, please make your way to the bookstore. Also, YouTube and Facebook, share this link, subscribe to our YouTube channel, and just please share the link. Invite others to join in. We want people to hear this conversation. We are dealing with business. We're dealing with Black wealth. We're going to be talking all that, and we need this information. Okay? So share. All right. So, Xavier, you ready?
Always.
And I'm going to get you some water while you're talking, but go ahead and do your thing.
Thank you. Well, I really appreciate everyone joining us today. I know Black Business Month isn't something that everybody is so familiar with all the time, but we want to make a great opportunity to highlight great businesses like the one that we're in today, and hopefully great authors like myself and others that are bringing new material out and trying to change the way that people think about business and activity. So a little bit about myself. My name is Xavier Egan. I am an alumni of University of Texas at Arlington here locally. Also attended a lot of other universities as well. But since we're in the DFW area, I want to make sure we're highlighting that other UTA. All right. As well, I've studied accounting and finance, and eventually I aspired to be a business owner. Searching for the right type of business to be a part of, searching for the right type of place, the right type of entity, and the right type of build out was really what I was looking for the whole time. And just lucky me, I found mergers and acquisition. So we're going to talk a little bit about that today as a part of our business month topic, and things that we just might not say as often. We're going to talk a little bit about entrepreneurship through acquisition today. And part of that is to really talk about that business is a great viable topic, right? In America, it's $24 trillion worth of general gross domestic product that's built out of all business activity. Even better, small businesses curate 44% of that GDP. And when we say small, we start with 500 employees or less, like the SBA standard, but we actually get down deeper and deeper into the numbers, and we realize over 82% of all the companies that are in America have no employees. Just pass-through companies, LLCs, things like that, shell organizations. Maybe about 2% have about 20 to 500 employees. And those are larger companies that a lot of us are familiar with. The real truth about it is that about 16% have only 20 or less employees, and those companies employ 47% of America, right? So the idea that business is important is great, but small to mid-sized businesses, the ones that all of us are able to touch, know, and love, and not only know the owner, but all the great patrons that are part of it every day, is a part of that real spirit of growth and economies of scale that's created all the time. So in our case, I know everybody wants to be an entrepreneur, but we want to talk a little bit about entrepreneurship through acquisition. And the idea there is sometimes we talk a little bit in metaphors, right? So to put it closer to where people are more familiar, most times people think about getting into business like flipping a house, right? Everybody knows about real estate. And in flipping a house, you're going to go into a bad neighborhood or something that's not perfectly fit from a house situation, and you're going to have to add a little value in, right? You're going to have to build out. You're going to have to put progress to it. You're hoping with that bad frame and the good work and good effort that you put in that you're going to create value, right? That's the hope of creating a good business, right? Sometimes people don't do it. Unfortunately, statistically, 20% of businesses fail the first year in operation, 50% by year 5, 70% by year 10. So those are harsh statistics in regards to how do we become successful? How do we make it work? So back to that metaphor, right? That we're thinking of business in that way. That most of them fail. So sometimes they're like that negative house or that flip, right? Well, we want to talk more about buying established, profitable businesses, which I more like to think of like buying your starter home, right? When you get that first house, you go in and you see that backyard and you say, man, this is how my kids are going to play. I'm going to put a little set right there. I'm going to have my garden over there. You walk in and say, this is going to be my man cave or my she shed, per se, right? And you know exactly where you're going to put that. And you see the value of that framework of that house that's already there and how you're going to add more value to it by growing in it, growing your family in it, adding your furniture, adding your piece de resistance, right? Of whatever your flair and flavor is. Well, that's how I like to describe buying an established profitable business. You're starting where someone else left off, right? It's not bad. It's just that they moved on. Maybe they got a bigger house, right? Maybe they're older and they decided to downsize and have a smaller house at that point. But more the metaphor is about most times we're getting into business thinking like flipping a house. Well, we got to go negative first to get the positive, and it turns out to be an alternative. The idea in some of the corporate mainstream versions is why build when I could buy, right? And a lot of times we just don't know that option or opportunity out of there. So that is really what gets us full circle to why we wrote the book, right? I wanted to tell people about the great opportunity that's out there that every entrepreneur hopes to grasp, which is to be a successful entrepreneur, and how we could potentially do that without working as hard, without all the negatives and the negative cash flow that might become between us. So, Main Street Boom, uncovering the generational gold mine, is honoring the idea that Main Street companies or small to mid-sized businesses are the majority of the value that we create in society. We saw that plain and simple as the pandemic came around. Hopefully, we'll have another one of those. But those regular companies, those regular people not showing up to work stopped everything, right? We want to tell you about how the next boom is changing hands on those particular businesses. Again, sorry to be heavy on stats, but when we talk about the older generations, people 55 years and up, right? Whatever generation we want to call that these days, as it tends to change sometimes, it's disproportionate in society. They represent about 21% of the people around. However, they own 51% of the privately held companies. And one of the new generational curses is nobody wants to be their parents. So no matter how happy, sad, rich, or poor, a lot of times we move off to new lands, new places. I'm originally from Houston, Texas. Shout out, right? But other people move from different places to come to great melting pots like the DFW or move away. So it's sometimes hard to say that I'm going to live my father's life or my mother's life or that parent's life before me when they might have to move out to be close to me to participate with the new family, right? The new generation. So that's created a chasm where all of those business owners, which have created some of the most profitable businesses out there, have to change hands with somebody. But if their son or if their daughter or if their granddaughter doesn't want to be the next person to take over that profitable established business, that gives us the gold mine opportunity, where each and every one of us who was saved and accumulated and created growth for ourselves can now use that as a down payment on that new starter home. And in this case, a down payment on that new business that in this case might not be a startup because it's established, it's profitable. It already comes with the customers. It already comes with employees who know what they're doing. It already comes with the history of banking partners and vendors and relationships. All those things that create the hardships about growing a business on your own, about creating value for yourself. So the idea in Black Business Month is to make sure that we're successful as business owners by any means necessary. And one of those means could be buying our way to that success. So it doesn't have to be all the time that we're starting from the bottom, now we're here. In this case, we can start from where someone else left off and go even bigger and broader from where we want to invest and what we want to put into that business. So we just wanted to talk a little bit about that snippet of what M&A means. Mergers and acquisition. Sometimes we say the little M and the big A. And the opportunity to buy some of these great businesses that are out there. One of the great value sets is that not only are all these businesses going to come available because of their older age, just naturally grading out, but Forbes suggests that there's going to be $14 trillion in value that has an interchange between those companies that already exist in the market and someone else being the boss of those companies, someone else being the caretaker of those companies, someone else being the one who stewards those to success at further heights than they're already at. So the idea here is sometimes we don't have to start from the bottom. Perhaps there's another alternative. Maybe we want to get into our first starter home or that first business that's going to take care of our families day one and provide that cash flow versus starting from the bottom, which might be that negative cash flow of having that fixer-upper. And sometimes, even though we have the greatest and the brightest and the broadest idea ever, it still starts with negative cash flow. Or as one fine poet said, the outcome has to become income, right? And so we have to spend money to make money. And so sometimes we don't beat that particular margin call, right? So we wanted to take a little bit of time to let you know that Main Street Boom, Uncovering the Generational Gold Mine, is not only here at the Doc Bookshop, but it's available anywhere that you can also purchase books. We'd love for you to come down here and purchase from one of our local establishments. But of course, we understand that we want to make availability of this great knowledge to anyone, everywhere. So I'd love to take a couple questions to see if there's anything that I can help you guys clarify. There we go. Yes, ma'am.
I'm just curious, what are some examples of businesses that you have acquired? Like what's out there?
Excellent question. Well, sometimes we, start there because we're only familiar with businesses in our community, right? We don't always know a guy who owns every type of organization out there in the world. So here's the shocker: everything out there in the world, right? It turns out that every type of small business entity that's available could be potentially available for sale, right? The idea that today, based on the last 2017, vote, there's only one type of company in America we can't buy, and that's a law firm unless we're a lawyer. But right now, we can buy a whole hospital, we can buy a nuclear facility, we can buy a dry cleaner or a landscaping company, all the way to an accounting firm or a recruiting company or even a marketing firm. So whereas we think that we're limited based on just the skills that we have to create, the reality is if we start where someone else left off, we can actually start anywhere that we decide. And we can use our skill set and our history to help build on whatever that is that they've already got. Yes, ma'am.
All right. It's so glad that you published the book. Congratulations. And it's Black Business Month. And so my question is related to the wealth gap.
Mm-hmm.
I saw that there was an article that was published that said the Black wealth is increasing, but the wealth gap is getting bigger for our community. How does the M&A strategy fix that?
Yeah, so when it comes to businesses in America, there's, say, 33.2 million businesses that exist out there. If we talked about what's the minority impact in those businesses today, well, first, let's just talk about the count of those businesses. Well, 17.77% of all businesses are considered minority-based, which includes every minority in our country, and including women-owned businesses, which turn out to be the majority of those minority-owned companies. Then we talk more further in detail to the specifics of what types of minorities that we might be interested in highlighting today. Well, Hispanic community owns 5.6% of all those businesses that exist out there. The African American community, which theoretically might have been here for a little while longer, in certain cases, only owns 2.2% of all of those companies. So when it comes to the $11 trillion that's been made out of small businesses in America, only 2.2% of that could potentially be captured by us right now, because that's all we exist in the business mainframe. So as the monetary expansion is happening and as businesses are getting bigger and there's more money getting created in the system, like technology companies and things like that, where more money is shifting, unfortunately, we're not growing more money for ourselves. Part of that is, unfortunately, starting more businesses that don't end up being successful and takes more capital from us and takes more wealth from us, versus creating more things that create instant wealth for us. So in this case, buying an established profitable business can make an opportunity or an avenue for us to buy cash flow first. One of the reasons that private equity and the larger guys in the country use M&A as the number one growth tool is because it's the only asset class where you can buy cash flow, right? And to put that in more simple terms, if we were in a dry cleaner, you go in a nice neighborhood, everybody goes to that dry cleaner. You know, the lady behind the counter, she goes and grabs your clothes before you even come in. There's a guy in the back, starching it up just like you like it, right? You don't even have to ask what's happening, right? So you go into that cleaners, you've never met the owner a day in your life. You just know your favorite gal at the front and your favorite guy in the back who holds you down. So we're selling that particular cleaners, and on Thursday, when that cleaners is sold, the new buyer comes in on Friday, and every time you swiped your card the day before, at the end of the day, that settlement account went to the seller and went to that owner's account. Now that you're the new owner, you're the buyer, and Friday, you now own this company. All of those workers still work there. They're all still doing what they need to do. Customers still show up just like they were doing the day before. The difference is when they swipe that card, at the end of the day, the settlement goes to your account, right? Well, in any other asset that we typically buy, we have holding periods, right? We have growth periods. We have what I like to call putting my money to sleep periods, right? Where I have no access to that liquidity. I can't use it for my lifestyle. I can't pay bills. I can't feed my babies. I can't do any of those things. Whereas when we buy companies that are profitable, cash flowing, and successful already, we have all those things available to us day one. Hopefully that helps.
Thank you.
Absolutely. Any other questions come to mind? Yes, ma'am.
Hi, I'm a junior at UTA, and I was just wondering, what are some things that I should be doing right now in terms of how can I build my wealth? I'm just in college again at UTA and a member of Zeta Phi Beta Sorority Incorporated. But, you know, what should I be doing right now?
Trying to create capital and savings, right? Ideally, in order to get and take advantage of any investment, you have to have some sort of liquidity in the first place to be a part of it, right? So you can't invest in the stock market if you got zero. You definitely can't invest in yourself if you got negative money, right? So the first step is to create some value for yourself. If we could turn the clock back in time, I might have went to school and as a member of Alpha Phi Alpha fraternity, I might have studied a little harder, right? Instead of having as much fun. And then I would have got the best job I could have got after college, getting the max salary. I would have matched out all of my retirement savings. And then I would have used a tool that maybe you haven't heard of called a ROBS, a rollover business startup retirement plan. It allows you to move all or part of your retirement dollars completely tax deferred, tax free, where it creates a company that you and your retirement own. And now you can use that money to start a company, or better yet, use that as down payment money to acquire a company of value that already takes care of you and your family. So instead of me working so hard in corporate America and taking so long to get back to that entrepreneurial path because of the negative cash flow, and me wanting to take care of my family, rightfully so, maybe I could have saved up and utilized some of these tools to acquire a company that could have taken care of my family and also made other dreams come true, like making more free time, more availability, more time to volunteer, more time to write books, so on and so forth. Whereas I had to do so much energy and focus into making sure that I continue to make value for my family. Yes, ma'am, in the back.
It's a two-part question. One, have you done small business brokering? And the part two of my question is, should there be is the goal to create generational wealth or to find an exit strategy? Because, like, I was looking at Caterpillar Books in Colorado.
Okay.
You know, they sold a venture capital merger. They had a merger. I don't know what the acquisition.
Mm-hmm.
They, in turn, just recently sold to Barnes and Noble.
Oh, yeah.
So that was, so you're just in this, I'm just looking at a micro level of the book industry.
Mm-hmm.
And seeing, you've they had stars in their eyes with the pandemic, everybody's sitting at home watching TV, with books in the backdrop, and then, it was real big about blacks, support black-owned businesses.
Sure.
To find out that they gained all this traffic and then turned around and sold it. So were you at really supporting black-owned business? So which one is superior, your mission and your generation, or to create money and fool the marketplace? I don't know.
Oh, I love where you're going here. That's a loaded question. Okay, forgive me for not giving you and expounding a little bit more on my history. One of the things that happened for me is I started as an accounting and finance guy, and I learned from corporate America, and as I chased to try to find out what types of opportunities were there, the last corporate opportunity that I worked was doing $2 billion when I got there and $5 billion when I left, and they were just an LLC. This company had 10,000 plus employees, over 50 plus countries, and it was just an LLC. The tried and true, most available type of entity for any of us. And this was completely contradictory to what I had learned in school. So I wanted to know more, right? What are they doing? How's that work? Why can't we have and build businesses just like that? And what I realized is that this company was one in a $50 billion private equity portfolio, where this company was just buying entities, adding more value, and selling those entities over and over. So to answer the two-part question, the first part is when I left corporate America, I started buying companies, all right, for myself and my family, trying to figure out how to be like those large guys in the sky. And I realized that there are a lot more smaller companies than there are bigger companies. So I didn't need $50 million to make this happen. It turns out that the SBA funds these types of transactions if they're profitable, established, and ready to roll. Then the SBA only requires a 10% down payment to acquire a company that's already willing to pay you day one. And one of their criteria is, number one, that it covers the debt service of you borrowing the money for that deal. And number two, that it pays you a salary to make sure that you don't rob Peter to pay Paul, right? Which most often is what fails our companies, the lack of cash flow to take care of our families. So I bought second or third company, a Main Street M&A firm. So I've actually been a practitioner since 2007, where we own a mergers and acquisition firm here in the Dallas-Fort Worth area, serving people all over the country and all over the world. Now, to your second question, which was, should exit be a part of the theory of constraints, or should it be generational wealth? Well, only 20% of all companies exit successfully, all right? So out of the 33.2 million companies, that means that there's only 6 million companies that are valuable to interchange hands at any given time. That also means that whether a company is 10 days, 100 days, or 100 years old, most likely it's going to disappear. And we've worked for a lot of those companies ourselves, and we probably built a lot of those companies ourselves too, that have disappeared over that time. So if only 20% of companies exit successfully, then is not the value of something that you created the price that somebody's willing to pay? In every other version, when we have a product, that's what we tell ourselves, right? That the value of my product is what someone else is willing to pay. So why wouldn't that be the same context in how we create value in businesses? That the value of the business, of what I've created, put my blood, sweat, and tears into, taking time for my family, taking time for my life. Why isn't the value of that the cash that I'm able to collect when I sell it? That is why we want to create more thoughts around that, right? Why we want to talk more about that. When we say generational wealth and we think about things like investing into certain assets, it takes 30 years to recover value off of those assets. That is why we call it generational. You won't be around to enjoy that. That's the difference of saying generational. I don't think we need to wait. I don't think we got to wait like great-great-grandma till somebody's dead, okay? Till somebody's gone, till we've exhausted all of our energy, till we've exhausted all of our money, we've exhausted all of our spirit. There's an opportunity where we can simply buy companies that already exist. And that's the same opposite of the equation. That why wouldn't you want to create a successful company that someone else wants to buy? And that's a part of how you create true generational wealth, right? Because wealth means that you have the liquidity to take care of yourself today and the liquidity to take care of your family tomorrow. And when we more often talk about wealth, we're talking about retirement. And retirement only takes care of me as an old man and my wife, okay? My kids ain't a part of that. My next generation of babies aren't a part of that. There's nothing that I've built in that case that actually is helping generational wealth actually be achieved at that point. I'm only creating enough for myself. So that is why, to your second question, should selling your business be a part of your plan? Well, if you've had the opportunity to take advantage of any of the SCORE classes or courses where they give free mentorship or some of the business planning one-on-one kind of courses, they would tell you that if you went through business planning, you should begin with the end in mind. What was the end? What was the end of the road? Was it to die at your desk? What was the plan? Hopefully, the old school plan was 60% of us believed that we were going to give it to our son. We were going to give it to our daughter, right? However, less than 10% of the time is that actually occurring in real life activity today. And that is what's creating that generational gold mine, right? That we're able to uncover. And part of that is learning how to create that growth for yourself. And if you haven't created it yet, maybe you could do it by starting where someone left off. And then the other side is maybe you created a business valuable enough to sell for yourself so that you can create more value by buying something else bigger and better and going up that ladder and creating ascension for yourself. Sometimes we think that the only way to create and the only way to have growth and value is to do it with negative being the way that we start. And we're just trying to talk about today that sometimes it doesn't have to be all negative. It is another way, and there are alternatives. So in this case, selling your business is just as valuable as buying a business. And most times, if you're not ready to sell, it's because you haven't created the value that you're looking for. And if you haven't created the value you're looking for, then you probably should think about the number one growth strategy, which is to buy. Take advantage of what someone else has built, right? Take advantage of their revenue, their cash flow. One of the biggest hurdles that people have is, number one, starting a company, right? The negative cash flow to get over that hump of having enough money to take care of myself and my family. The second biggest hurdle that takes companies out is the same exact issue, negative cash flow. But the difference is it's growth. So in order to grow and add a new territory, add a new person, add a new staff, add a new location, add a new country, I have to spend money before I make money, just as if I started that company brand new. So even in established companies, it's like we're creating new startups every time we think that we want to add more value to it. And sometimes we're not in a position to sacrifice again the same way that we sacrificed when we started the company in the first place. When we started, we were apt and ready to take on negative cash flow. We were eager with all our passion to take this opportunity to grow and create value. Now we're taking care of our family. Whoa, there's bills, there's stability. Can we grow and get more value? Well, that's when people sometimes fail, because as they try to take that stride, it's hard to balance both legs, right? One in growth, which is costing me, and one in stability, which is okay for me. So the number one reason that some of these companies have grown so large and so vast and have so much of the GDP is because instead of building, they're buying. And instead of creating, they're acquiring. And we're just trying to show you how you can do that same thing. Any other questions come to mind? Yes, sir.
Thank you, Xavier, for writing the great book. We appreciate your knowledge and your wisdom. By the way, thank you for being my LB of the great Alpha Phi Alpha fraternity. A question that I have is, can you provide a possible practical example that in 2024, what an individual would need to, say, go purchase a small business? And in doing that, would your firm be the firm they would need to talk to in order to do that?
Okay. Good question. So I try not to bore people with numbers, and details. But to break that down as a small example, I always say that stability is key, right? We don't want to be buying into something that's already flickering, the lights is flashing. That's more like that flip, of a property and finding that negative first. So more often, there's more stability with more revenue, right? More people, more positions, kind of thing. So we traditionally say that $1 million value company and above is where you would want to start. And the reason is because anything under that value of about $500,000 or less, a bank feels that that's a personal thing. That's not a real business. You may or may not be around next year, 3 years from now, 5 years, 10 years. I don't know. And I don't trust it. So I'm going to give it to you like a startup at that point. So maybe you need to pull your home equity line or take all your savings and dump that in. But if you go at $1 million and up, they feel like that has to have created enough value and stability wise for you to be able to take advantage of it. Again, it has to pay its own debt, number one. And number two, it has to pay a salary for you to take care of your life and your lifestyle where you sit today. So the $1 million company, if we were breaking that down a little bit further, in order to create that value, how do you come up with a price of $1 million, for instance? Well, we would be looking for cash flow or owner's benefit, right? So the only value that we're creating in a company is how much I get to take home and take care of my family. I could be spending millions and millions of dollars employing people, hiring, firing, buying stuff, moving stuff around. But if nothing is going home to my family, unfortunately, that is not valuable, right? There is no interchange, right? Yes, it's an economic good, but when it comes to an owner and taking care of your family, which is what this is about, you need cash coming out that business that comes to you. This ain't a nonprofit. This ain't a hope. This ain't no, just we believe kind of thing. So in that case, it would have to be doing $200,000 to $300,000 in cash flow back to the owner for a multiple to get it closer to $1 million valuation. The beauty of that is for every $1 million you borrow, plus or minus, for all my bankers out there, it's going to be about $100,000 in debt service. Means you spend $100,000 a year to pay down you borrowing that $1 million day one. So if I got, say, $300,000 in cash flow from that company, I theoretically am paying the bank $100,000, and I could be netting $200,000 or $150,000 or $100,000 myself as a part of that salary, compensation, and worthiness to me. What would it have taken me to get into that business? Well, if the SBA, again, only requires a 10% equity injection, then that $1 million company was only $100,000 in investment for me to get straight into cash flow. Well, the funny thing about that is if we look at the statistics of what happens when a person starts a business, on average, 27% of people spend $250,000 to $500,000 investing into themselves with negative cash flow, not knowing if they're ever going to get positive. And that could be the fact that they've left their job, the opportunity cost of how much they could have made, the fact that they've dwindled their savings, that they spent all this money for themselves, they bought the office, so on and so forth. And that could be one day or it could be 2 years that it took them to really get that off the ground of all that consistent investment into that company with the hope that the outcome is going to be income, right? Versus the alternative is that I could have found a bankable, established, non-startup, profitable company, and the bank would have given me 90% to buy that company, and I only needed to put in 10%. Just extrapolate that forward. Maybe 100,000 isn't all you got. Maybe you got 200. Maybe you got 300. Maybe you got more. Well, that just goes back to buying cash flow. The more money I have for down payment to leverage buying that company, the more cash flow I can buy, right? So it doesn't have to necessarily just be one company, or it could be 10 companies, right? The idea is any company that you would buy in this subset, it will be first established, profitable, and ready to roll, right? And then to your second part, absolutely. Our firm does handle buy-side and sell-side representation. But like any industry, similar to real estate, you don't need anybody's help to go do a thing, right? You can buy a property any day of the week without a realtor. But it also might help you to have an expert by your side, right, to go about a transaction. And that is something that we do. Yes, sir.
What's your opinion on buying distressed businesses?
There's an absolute opportunity for that. But similar to flipping a property, there also is a different amount of risk that comes with it. The reason that I talk about profitable established companies is because the top 4 reasons that are created risk-wise of failure, it already subdues. The number 1 reason, cash flow. 85% of businesses don't make it because the outcome doesn't meet the income, right? Then you got market fit, you got talent, you got customer base, right? That I might have just made up something that doesn't work. So all of those are reasons that all companies fail. So when you're in a distressed company, those are all going to be a part of the concern still that you have to deal with. So I would say that there could be infinite value to buying a business that's distressed, but you may want to be a stronger steward to do that, right? When you have the alternative to buy something that's not distressed at all, works perfectly for you, and pays you instantaneously as an option, and then you have the other option that maybe there's a discounted price, more preferable, but it comes with stress, strife, and similar to a startup business, right? Because it is negative and you need to add more value to get to positive, right? So hopefully that answers. Yeah, exactly, right? So you're familiar with that. In real estate, we do it quite often and take that bearing of risk and we put our money to sleep over that period of time. So the difference here is that if we were buying profitable established companies, we would have liquidity the entire time because we got a salary. We're on payroll just like everybody in the company that we own. We've got the same insurance benefits as everybody who works there. And in other asset classes that we're trying to create value, growth, and wealth for ourselves, we're missing everything else that we need. So we have to compile multiple assets to cover that same baseline, right? That real estate's not going to take care of family benefits. You know, that's not going to be a thing. You know, that stock portfolio is not going to take care of instant liquidity. You know what I mean? That Bitcoin account surely isn't going to do that, as you might want to hold that forever. So this goes back to all the different options. And if we were truly going after wealth, then we think about diversification, right? And in diversification, we want to be in multiple markets because not every day, every market's going to be good. Some days that market's going to go down. So where they do it in the wealthy sphere, they're owning multiple companies in different markets. We're only learned about doing that in index funds, right? Or crowdfunding, you know, where we're letting somebody else get us diversified. We could own multiple businesses that are all successful, independent of each other, have all their own things going on, and we are the utility in between them. And that's more how they work it at, say, a private equity or more sophisticated level. I just want to make sure that we all know that we can be that person too. It doesn't just have to be some rich guy pie in the sky type of move. This is something that we can all establish for ourselves and we can grow through savings and access to say, hey, today I might not have that money, but let me work and put a few more dimes and pennies together. And when that time is right, why choose this when I could choose that? So I'm just here to get the Pepsi challenge, baby. Yes, ma'am.
I'm just curious as to who are your role models? Like who
Mm-hmm.
your mentors? I mean, who do you look up to? Like who inspired you to do this?
Sure. So, you know what? I'm going to give credit to the Alpha Man, right? He's going to reach out to me and we're going to be best friends after this. Robert Smith. As a matter of fact, part of his story and what he said in his lessons and viewpoints is it's something that I couldn't learn in B school. And that was the opportunity to get out there in the real world and participate, to get real experience, to do transactions, to work, to fail, to learn, to love, to live, all of that great stuff. And in his case, he's one of the best out there, right? As he has a huge multi-billion-dollar portfolio at this point. Yes, sir.
I thought you would say Reginald Lewis.
Yeah, you know.
He was one of the first.
Yes, he and a Kappa man at that. So in case anybody thought I was being biased, right, I'm gonna say it all. Yes, Reginald Lewis, and he wrote a great book that you should all check out of why the white boys shouldn't have all the fun.
Why should white guys have all the fun?
Yeah.
That's right. But I did not choose him. Okay, sorry, frat. Reach out to your boy. Thank you. But yes, people who are thinking in more portfolio styles, right? He was an early stage where he did it in the cut and dry version that he had. Robert came a little later, and he actually started an venture, which is a way more risky side of that whole transaction. And somehow he not only went through dealing in startups and the riskiest type of businesses like distress that you can provide, all the way to becoming one of the top venture, now private equity companies in the world. And so it's just a different, route. And of course, He also was a study person who, went through a different varied career where he was an engineer prior, similar to me being a technical person in the accounting realm, and decided that why should they have all the fun, and decided to get into finance, right? Knowing that that is how they're building the bricks that they're laying to create all streets in the world, right? So for me, his was an inspirational story that was a little bit closer, especially since he's right down the street in Austin.
But one thing, in personal opinion, for the African Americans, I think a lot of times, a lot of us don't look at becoming a major business.
Sure.
You want to be the mom and pop. They don't want to, don't want to deal with building up a big business, through acquisitions and things of that nature, because it gets a little.
I like that.
It goes to a different level, and if you don't have the, say, educational background, you don't see how you can get there. Like I tell people,
I
you
love
don't
that.
need to be educated. You just have to know enough to hire people who get you there.
So sometimes there's lots of misinformation, right? And this goes back to most times when we think about business, we think about all the hardships, everybody who failed around us, all the things that went wrong. I'm talking about something totally different. And sometimes we're just not open to hearing different strategies. So a lot of people say that about business. Well, Johnny Moe had a lot of employees and that was the bane of his existence, right? He wasn't making a lot of bread. Well, great, because his isn't a successful company that we could buy in the first place. His isn't the type of company that the bank is even willing to finance or fund because he wasn't in a set or position for it to be transferable. And that's part of what we haven't seen. We create businesses that what we call are lifestyle. So they're good enough for me taking care of my family. They're just right. It's like having a pocket corner that every time I shoot, I know exactly how it's going to be fitting into that cue ball because I've shot it so many times. So I'm comfortable with that. And sometimes we don't ask if comfort is the cousin of complacency, like sleep is the cousin of death. So the question is that comfort in the way of growth and opportunity and scale? And are we using that and the excuse of that history to be the barrier, right? Whereas we could buy a company that isn't set up at all like that. We could buy a company that the staff already knows what they're doing and already has a customer base. We could have a company that's already beyond the failure statistics of what happens typically in that industry. So we can choose to be a little bit more specific with our money and a little bit more smart about how we do our investing. And so again, that's just why we're having this talk today, to offer a different set of knowledge, a different set of eyes and ears and perspective of what could be possible versus just believing that only what our eyes and ears have seen and heard is only what's available. And that's part of our flaw, is that in our communities, we don't have everything right now. We don't own everything right now. So we don't have an example of everybody in the best steward in every seat. And I'm trying to be a part of changing that, right? You, as you said, instead of having to be the expert at construction, could just be the guy who has the money, the willpower, and the brilliance to say this team could be better and I could be a leader of that particular team versus I'm the best guy with my hands. I could build it to the sky, but I don't know anything about business. So it's really about SWOT analysis, if you've ever heard of that term. Strengths, weaknesses, opportunities, and threats. Most times people are looking more at the strengths than the opportunities that they have. The real thing that's going to knock you out the box is the weaknesses and the threats. And that's things that are internal that affect me, weaknesses, and threats are things that are external that I can't control that might affect me. And that's what every dollar that we're spending and putting out in the community, we're trying to guard, we're trying to be better with, right? And we're trying to be smarter with. So hopefully those dollars last in our communities longer, and hopefully they last in our pockets longer, right? Even better. Yes, ma'am.
I know he asked about distressed businesses, but what about for sale businesses that are cash flowing and they have liquidity in place? What about, do you guys come across those type of businesses? Like,
Oh, absolutely.
When I say for sale, because of what's happening at the top of the leadership and the board, and there's compliance issues, but it can still be a cash flowing company.
Yeah, so love that question. Most times our experience with acquisitions or mergers is based on us working for very large corporations, right? And so the types of misinformation or thoughts that we have about it is from that context, right? That those are the types of problems or things that we even deal with. In a regular business, as I stated with the statistics, 16% of all companies are only 18 employees and less, employing 47% of America, making 44% of GDP. They ain't got no boards, man. That don't exist. They don't have structures like that most often. Really, it's just some guy who runs this company, and whether he does it, for word of mouth by getting clients or has a great marketing system, either freaking way, he's made something successful that has more value than you have in your hands right now. And that is what we typically have is on the for sale market, right? Businesses that are profitable or doing well to some degree, and they just want to change hands. But the reason that we think isn't the reason that it's happening, right? It goes back to the statistics. If 51% of the companies are owned by baby boomers and folks that are older generation, then the same thing that we're seeing in corporate America, where they're being bounced out because of the old age and making the most money, in private America, they're choosing to opt out. Why do I still need to be here? I've already paid for my boat house and the lake house and for my kids through college. What am I still staying around here for? Dealing with people and all of this. I could be in Colorado right now, man. Like I could be in a better place with better temperatures and more fun for my life. So most often, the number one reason for sale is retirement or relocation for a profitable, successful business. Versus what we most often think is, man, there must be something, some hook to why they must be moving on. That it must be something under the hood that's got to be scary and problematic and all this issue. But it goes back to financeable businesses. So why would the bank, the most profitable business in the world, risk 90% of their money with you for something risky? They wouldn't do it, right? So that also gives you more credibility, right, to what's actually happening in this market, that they're willing to do that, whereas in real estate or some of the other lending capacities that the bank will give to us, 20 to 30% equity is what we have to put in, and the most they'll do is 70 to 85%. Now think about that. The best asset that we all know and love, real estate, they're only willing to give us 70 to 85%, but yet businesses, which make up the entire economy of every economy across the world, they're willing to give us 90%. There must be something to it. There must be some value to that particular positioning. And that's why I'm being very specific about saying profitable, established companies. The bank's not going to fund anything that's less than 2 years old because that's a startup. They don't believe in that. You have no history, no tax returns, no stated value that I can prove. So I'm risking everything just like venture. So I'm going to treat you that way, and I'm going to unfortunately give you less lending capacity because of that. So that is why I'm not saying distressed. Nobody's lending you distressed money. You have to get equity investors. They have to be in partners with you, in bed with you, in cahoots. It's not all your money anymore. You got to share. However, what you can own 100% of, and 100% of the cash flow, and take care of your family 100%, is by buying an established company that already has the cash flow, already has the profitability. And this book is about why that's available to you, why you should get involved, why that's really an opportunity to uncover the generational gold mine. Main Street boom, baby. Right here. So again, wherever you have books available, we've got this book right there available for you. And of course, we'd love for you to come down to the Doc Bookshop, and we'll be wrapping up shortly. So, yes, sir. Last question.
No, you mentioned Colorado. I just come from Colorado Monday.
Mm-hmm.
Looking at a small, privately owned storage facility in Alamosa,
Sure.
Colorado. Owner, same situation. Owner retired, and the kids who are
Of course.
grown-ups don't
Moved
want.
Yeah.
So I'm looking at that, but it's good cash flow. I haven't looked at the numbers yet, but
Sure.
storage facility like this is one of the old storage facilities without the temperature controls.
No, absolutely.
So,
If we were talking real estate, they say there's 4 asset classes in real estate that are always good, right? Multifamily, storage facilities, mobile parks, and what's the last one? All of them correlate to people who don't have a lot of money, okay? And so that is why most often when we say businesses, people think about those types of businesses. But if we actually looked a little bit further, there's bigger and better opportunity, right? I always say there's a difference between growth and scale. Growth is I have this building, I can only fill up the capacity of this building. Scale is me having 50 of these buildings where they're all creating me revenue, right? So the idea of something like a storage or real estate kind of capacity businesses is that they're fixed based on the growth, right? I have to invest more assets to get more value out of it versus if I thought about service-based companies or anything else that has a scale kind of capacity. Well, if I have a marketing company, then they could do marketing work from anywhere and they could have customers everywhere across the world, not just in the backyard where they have that business today. So growth says that, hey, you know what, this is good, you know what I mean? But I'm trying to translate that we all have options and it's really good, better, best, right? That's good. There's a better option though. And best in class is trying to act and emulate what the most wealthy people in the world do. And that is why I'm telling and talking the strategy in a specific format and fashion. That I want you to emulate what the best of the best do. Use it like the number one growth strategy that it already is in the world. But if you do it a little bit different, it's going to give you different results, right? So again, hopefully, this is a great opportunity to check out Main Street Boom, uncover the generational gold mine, and get a lot more insight to how that could work for you. Why and what opportunities might be out there, where you could take your next scale, where the growth could be in your particular future, and how it might not be the way that you thought about originally. So really love and appreciate your time. Thank you for joining us tonight. Hopefully you enjoyed and happy to sign some books and make some more activity for you.
Everyone, let's give Xavier a hand. Thank you so much. All right. And thank you all for tuning in. We are signing off.